Welcome to this explainer. Today, we're doing something a little different. We're going to strip away all that emotional hype, ignore the flashy headlines, and run the cold, hard math on three major retail investing temptations. Because, as you'll see, the numbers often tell a very different story than the marketing department.
So think about this for a second. What on earth do the SpaceX IPO, dividend stocks, and your everyday 401k have in common? I mean, at first glance, a heavily hyped rocket company, passive income strategies, and a boring workplace retirement account seem completely unrelated, right?
Well, here's the kicker. They all hide massive financial blind spots. We're talking about incredibly convincing illusions that trick regular investors into losing out on wealth. And it's not because of what they see, but because of what they don't see. We're going to expose exactly how these blind spots work.
All right, let's just dive right into our first reality check, the highly anticipated SpaceX IPO. You've almost certainly heard the pitch. Imagine if you had the chance to invest in Amazon way back in 1997. It's literally designed to trigger our ultimate fear of missing out on the next big market rocket. It just short-circuits our normal, rational thinking.
But listen, a great company and a great investment, those are two completely different things. Just look back at some of the high-profile tech IPOs we've seen lately. Uber dropped 50% in a matter of months. Lyft lost 70% in a single year. WeWork, they pulled their IPO entirely and went bankrupt. Rivian dropped 80% in a year. While private valuations feel really concrete and exciting, richly valued private companies often crash spectacularly when they finally meet the cold reality of the public markets.
Now, get a load of this number. $350 billion. That is SpaceX's last reported private valuation. To put that into perspective, that makes this private company bigger than Goldman Sachs or Boeing. It is an absolutely eye-watering number, driven by incredible enthusiasm. But you really have to ask yourself, what are you actually paying for?
Here's where the math gets wild. To justify that $350 billion price tag using standard discounted cash flow models, SpaceX would need to generate between $20 to $30 billion in pure annual profit within the next decade. For comparison, entrenched giants like Lockheed Martin earn about $7 billion. Boeing earns around $3 billion. So to justify its current price, SpaceX essentially has to out-earn every single aerospace company on Earth combined from a standing start. You are paying a very certain, incredibly high price for a very uncertain future.
Okay, so that's the illusion of the perfect growth story. Now let's pivot to Section 2 and look at the illusion of passive cash flow in personal portfolios.
Let's set up a little simulation. We're going to track two 30-year-olds over a 30-year time frame. Meet Jake and Marcus. Jake is all about chasing yield. He's throwing $1,000 a month into Dividend aristocrats, REITs, and high-yield ETFs. Marcus, on the other hand, simply buys the Vanguard S&P 500 index fund with his $1,000 a month and completely walks away. No deep research, no yield chasing.
So, fast forward a bit. Jake is seeing these quarterly checks hit his account, and he feels like he's already living the retired life. Marcus, he's just watching a number slowly tick up on a screen. On the emotional scoreboard, Jake feels absolutely fantastic. But let's run the actual math to see who truly wins this simulation after 30 years.
Here are the actual numbers. By age 60, Marcus's boring set-it-and-forget-it index fund is sitting at nearly $1.8 million. Jake retires with $1.4 million. That is a staggering $370,000 shortfall for Jake. He honestly thought he was winning this whole time. So, where did all that money go? Well, Jake lost out because of three invisible leaks that were just quietly compounding over 360 months. First, there's a 1% annual return drag. Dividend strategies historically return roughly 9% compared to the broad market's 10%. Second, a massive tax drag. Jake paid ordinary income taxes on his non-qualified dividends, handing roughly $48,000 straight to the IRS. And third, the expense ratio gap. He was paying around 0.35% for specialty ETFs, compared to Marcus's dirt cheap 0.03% index fund. He didn't lose because dividends are evil, he lost because of mathematical friction.
All right, let's move on to our third major workplace blind spot, the tax break illusion between traditional and Roth 401ks.
We're bringing Jake and Marcus back. Same company, both making $75,000 a year, both contributing 10%. Now, Jake picks the traditional 401k because, frankly, he loves getting that immediate tax break on his paycheck today. Marcus decides to absorb the tax hit today, using post-tax dollars to fund his Roth 401k so it can grow entirely tax-free tomorrow. They invest the exact same amount in the exact same funds.
Now, here is a crucial little detail that almost nobody talks about. Even if you contribute exclusively to a Roth 401k, like Marcus did, your employer matches almost always go into a traditional pre-tax bucket by default. Because of this, what Marcus doesn't realize is, actually, let me rephrase it. He thinks it's all tax-free, but about 28% of his final Roth balance is actually sitting in a pre-tax traditional bucket, just waiting to be taxed.
But wow, Jake's illusion is way bigger. Look at this. After 20 years, both guys open their statements and see an identical $461,000. But because Jake's money is all pre-tax, assuming a 22% retirement tax rate, over $100,000 of that balance literally belongs to the IRS. He actually only owns 78% of his own portfolio. The monthly statement totally hides this reality from him.
So what it all boils down to is this. Your choice between traditional and Roth depends entirely on one super simple equation. A Roth wins if your tax bracket goes up in retirement because you already locked in the cheaper rate today. A traditional wins if your tax bracket drops. That's the whole shebang. If you guess wrong, you could be giving the government tens of thousands of dollars of your hard-earned retirement spending power.
Okay, Section 4, the real wealth formula. We've broken down the illusions. Now let's build a mathematically sound strategy.
Here's your clear, structured game plan. Step 1. Always capture your full employer match. I mean, it's literally a guaranteed 100% return. Step 2. Actually check your current tax bracket to choose your 401k type instead of just guessing. Step 3. Rely on low-cost index funds for your core wealth to avoid return and fee drag. And finally, Step 4. If you really want to play around with dividend stocks, keep them inside tax-advantaged accounts, like a Roth IRA, where the IRS cannot touch that compounding cash flow.
Ultimately, whether you're evaluating a $350 billion space company or just setting up your own workplace retirement account, cutting through the noise always comes down to asking yourself this one uncompromising question. At this price, what has to be true for me to actually make money? Don't pay full price for a dream, and definitely don't let friction drain your wealth. Thanks for learning with us today. So I'm curious, what illusion are you going to check in your portfolio first?